For more than 50 years, one number buried deep inside America's financial records has barely changed. Most people have never heard of it, yet if that single figure were updated tomorrow, it could instantly reshape the US government's balance sheet by more than $1 trillion without printing new money, passing a new law, or even discovering a single additional ounce of gold. It sounds unbelievable, but this isn't some internet conspiracy or sensational rumor. It's a real discussion that has quietly entered serious economic circles. Federal Reserve researchers, Treasury experts, and respected market analysts have all examined the same question. What would happen if the United States simply updated the official accounting value of its gold reserves to reflect today's market price? Right now, America's gold is still officially valued at just $42.22 per ounce, a figure that dates back more than half a century. Meanwhile, gold trades above $4,000 per ounce in today's market. That enormous gap has transformed what was once a forgotten accounting detail into one of the most fascinating financial debates of our time. If that valuation were adjusted, the government wouldn't suddenly discover new gold or confiscate anyone's assets. It would simply recognize the true value of the gold it already owns. On paper alone, that could strengthen the Treasury's balance sheet by hundreds of billions, or even more than $1 trillion. Such a move wouldn't erase America's debt, but it could dramatically change how investors, policymakers, and global markets view the country's financial position. Today on AgJohn Silver Update, we're going to break down why this idea is gaining attention, what the historical evidence tells us, and why understanding this debate could help explain some of the unusual movements we've been seeing in the gold and silver markets. Before we dive deeper, let me know where you're watching from and tell me something else. If you had to choose just one place to store your savings, would you trust gold, silver, or cash? Your answer often says a lot about the economic reality you've experienced. People who have lived through high inflation usually see money very differently from those who have enjoyed decades of stable purchasing power. That difference reveals just how fragile confidence in a currency can become when financial conditions begin to change. Now let's look at the bigger picture. The United States is carrying an enormous debt burden. Federal debt is closing in on $39 trillion, and the pace of borrowing continues to accelerate. Government spending has consistently outpaced revenue, while annual deficits are projected to remain extremely high for years to come. Perhaps even more concerning is the cost of servicing that debt. Interest payments are approaching $1 trillion per year, with some months setting new records. The government is now spending more just to pay interest than it spends on national defense. That isn't a political opinion, it's simply the result of basic mathematics, and it's becoming one of the biggest financial challenges facing the country. When debt grows this quickly, governments eventually run out of easy solutions. They can raise taxes, cut spending, generate stronger economic growth, or slowly reduce the purchasing power of the currency over time. History shows that when the first three options become politically difficult, policymakers often lean toward the fourth. Instead of repaying debt with equally valuable dollars, they repay it with dollars that gradually buy less. That pattern has appeared repeatedly throughout history, from Europe to Latin America and beyond. Whenever debt expands faster than the economy supporting it, confidence in paper currency often weakens, and that's exactly where gold begins attracting renewed attention. Unlike paper money, gold doesn't depend on promises, political decisions, or central bank policies. Its supply can't be created with a keyboard, and it isn't someone else's liability. That's one of the main reasons central banks around the world have been quietly increasing their gold reserves at one of the fastest rates seen in decades. These institutions don't invest based on emotion or headlines. They think in terms of decades, not days. When many of the world's largest financial players begin moving in the same direction, experienced investors usually pay close attention. Silver often lives in gold's shadow, but the reality is far more complicated. While gold is primarily viewed as a monetary asset and a long-term store of value, silver plays two critical roles at the same time. It has served as money for thousands of years, yet it is also one of the world's most important industrial metals. From solar panels and electric vehicles to semiconductors, advanced electronics, medical equipment, and the rapidly growing artificial intelligence sector, silver is becoming increasingly difficult to replace. That unique combination creates a market unlike almost any other commodity. Investment demand can rise during periods of financial uncertainty, while industrial consumption continues growing as technology advances. When both forces move in the same direction, pressure on supply becomes impossible to ignore. And supply isn't as flexible as many people assume. Unlike gold, most of the world's silver isn't mined from primary silver deposits. A large portion comes as a byproduct of copper, lead, and zinc mining. That means even if silver prices surge, producers can't simply flood the market with additional supply overnight. Expanding production takes years, and in many cases, miners are responding to the economics of other metals rather than silver itself. Meanwhile, industry reports continue pointing toward persistent supply deficits. Manufacturers still require enormous amounts of silver, investors continue accumulating physical metal, and inventories remain under pressure. It's a combination that has caught the attention of many long-term analysts. At current prices, gold remains above $4,000 per ounce, while silver trades near $58. That places the gold-to-silver ratio close to 70, a level many experienced investors watch carefully because history shows this relationship rarely stays constant for long. Sometimes gold leads, sometimes silver catches up aggressively. The ratio constantly adjusts as market conditions evolve. Now let's return to the question that's generating increasing discussion inside financial institutions. Could the United States eventually revalue its official gold reserves? This isn't speculation pulled from social media. In 2025, the Federal Reserve published research examining how governments have historically changed the official value of their gold holdings and how those adjustments affected national balance sheets. The research exists in the public record and has encouraged serious debate among economists. The idea itself is surprisingly simple. If the Treasury stopped valuing its gold at $42.22 per ounce and instead used a figure closer to today's market price, the reported value of America's gold reserves would rise dramatically. No additional gold would be mined. No money would magically appear. The government would simply recognize the current market value of assets it already owns. That single accounting adjustment could add hundreds of billions, or potentially more than $1 trillion, to the Treasury's balance sheet. History shows this wouldn't be unprecedented. During the Great Depression in 1934, the United States increased the official price of gold from $20.67 to $35 per ounce, strengthening the government's financial position while effectively reducing the dollar's purchasing power. Then, after the Bretton Woods system collapsed in the early 1970s, the official accounting value was changed again to $42.22, where it still remains today. No one outside the Treasury or the Federal Reserve knows whether another adjustment will ever happen. Anyone claiming otherwise is simply guessing. What we do know is that several important developments are unfolding simultaneously. Gold has been flowing into U.S. exchange warehouses at an unusually strong pace. Calls for greater transparency surrounding America's gold reserves have returned to public discussion. Federal Reserve researchers have openly examined reserve revaluation, while the government's growing debt burden continues making balance sheet improvements increasingly attractive. None of these facts prove that a revaluation is coming, but together, they show that this conversation has moved well beyond internet speculation. Serious institutions are asking serious questions, and global markets are paying close attention. This is also where many investors make a costly mistake. They confuse possibility with certainty, hearing words like currency reset, financial crisis, or gold revaluation often triggers fear long before logic has a chance to evaluate the evidence. Successful investors understand the difference between facts and assumptions. They stay patient, focus on verified information, and avoid making emotional decisions based on headlines alone. Understanding the economy is important, but understanding yourself as an investor is even more important. Two people can study the exact same market data, reach the same conclusion about where gold or silver may be headed, and still experience completely different financial outcomes. The difference isn't intelligence, it's discipline. Imagine someone approaching retirement after spending decades building savings. Because previous market crashes left a lasting impression, most of that money stayed in cash and short-term bonds. As gold and silver climbed higher, that investor watched from the sidelines, afraid of making the wrong move. Eventually, the fear of missing out became stronger than the fear of investing. A large position was purchased near a temporary market peak, only to be followed by a sharp correction. Panic replaced confidence, and the investment was sold at a loss, even though the long-term reasons for owning precious metals hadn't changed. The mistake wasn't buying gold or silver, it was allowing emotions to control both the entry and the exit. Now picture another investor with a completely different approach. Instead of trying to predict every rally or correction, small amounts of money were invested consistently over several years. Physical gold became a long-term store of value, while carefully selected silver holdings and mining investments provided additional exposure. Every purchase followed a plan rather than a headline. Market volatility never forced emotional decisions because the goal wasn't to get rich overnight. It was to preserve purchasing power over the long run. That disciplined strategy removed the pressure to constantly guess what the market would do next. Then consider a younger investor convinced that a major financial crisis was right around the corner. After reading countless predictions online, nearly every dollar saved for a future home was placed into highly leveraged mining stocks. Even if the long-term outlook for precious metals eventually proved correct, the timing didn't. A normal correction in the stock market caused mining shares to fall much harder than the metals themselves. The biggest mistake wasn't misunderstanding the economy, it was investing money that would soon be needed into one of the market's most volatile sectors. These examples highlight an important truth. Being right about the economy doesn't automatically make someone a successful investor. Wealth is built through patience, proper risk management, and consistency, not by reacting emotionally every time the news cycle changes. The US dollar also remains one of the biggest pieces of this puzzle. Gold and silver rarely move independently from the strength of the dollar. Although the dollar continues to dominate global trade and international finance, central banks have gradually been reducing their dependence on it while steadily increasing their gold reserves. This transition hasn't happened overnight, but it has continued quietly for years. At the same time, policymakers face an increasingly difficult balancing act. Keeping interest rates high can help control inflation and support the dollar, but it also makes borrowing far more expensive and increases the government's already massive interest payments. Lowering rates can reduce that financial pressure, but it may also weaken the currency and allow inflation to return. Neither path is painless, which is exactly why discussions surrounding gold continue gaining momentum. Geopolitical uncertainty adds another layer to the story. Recent years have shown that foreign-held financial assets can become restricted or frozen during periods of international conflict. Physical gold stored within a country's own borders doesn't carry that same risk. It's no surprise that central banks around the world have accelerated their gold purchases as they seek greater control over their own reserves. History offers an important reminder. In 1971, when the United States ended the dollar's convertibility into gold, few people realized how significant that decision would become. Over the years that followed, inflation accelerated, the purchasing power of cash declined, and gold experienced one of the strongest bull markets in history. History never repeats perfectly, but it often rhymes. Today, governments across the developed world are carrying debt levels that would have seemed unimaginable only a generation ago. Rising interest expenses, persistent deficits, central bank gold accumulation, potential reserve revaluation, and continued silver supply shortages all point toward the same conclusion. The global financial system is entering a period of increasing pressure. Does that guarantee gold or silver will rise tomorrow? Absolutely not. Markets never move in straight lines, and short-term volatility is part of every investment cycle. But the long-term trends driving this conversation are real, supported by publicly available research and economic data, not internet rumors. If an official gold revaluation ever happens, it shouldn't be viewed as proof of a secret financial reset. It would simply represent one possible policy tool available to governments seeking to strengthen their balance sheets while navigating unprecedented debt challenges. For individual investors, the lesson is straightforward. Match every investment to your financial timeline. Avoid making emotional, all-or-nothing decisions. Stay diversified, remain patient, and focus on verified information rather than sensational headlines. Gold and silver are not guarantees of wealth, nor are they bets on economic collapse. For many investors, they simply serve as financial insurance, assets designed to help preserve purchasing power if inflation, excessive debt, or currency weakness become greater challenges in the years ahead. No one knows exactly what policymakers will decide next. No one can predict with certainty whether an official gold revaluation will ever take place. But the trends we've explored today are becoming increasingly difficult to ignore. At the end of the day, successful investing isn't about reacting faster than everyone else. It's about staying disciplined while others allow fear and excitement to dictate their decisions. Before you go, I'd love to hear your opinion. If the US government announced tomorrow that it had officially revalued its gold reserves, how do you think gold, silver, and the US dollar would respond? Share your thoughts in the comments below. And as always, thank you for watching AgJohn Silver Update. This content is provided for educational and informational purposes only and should never be considered personal financial advice. Always conduct your own research, evaluate your own financial goals, and make investment decisions that align with your individual circumstances and risk tolerance.